Right now, 6 stocks are sitting at a crossroads. 3 of them could quietly build serious wealth for patient investors over the next several years. The other 3, no matter how exciting the story sounds, are priced in a way that makes them genuinely dangerous to hold right now. And before this month ends, you need to know exactly which is which. Stay with me, because this one video could permanently change how you look at the stock market. Welcome back to Market Authority, the channel that skips the noise and goes straight to what actually matters in investing, the numbers behind the story. If you are new here, hit that subscribe button right now because we break down the market like this every single week. Today, we are walking through 6 stocks all over financial media right now. We are going to figure out what each business truly looks like under the surface, and then ask the only question that matters: is this stock worth what the market is charging for it? Here's the one idea I want you to carry through this entire video. A great company and a great investment are not the same thing. This distinction alone will protect you from more losses than any stock tip ever could. The price you pay determines your return. You can own the most dominant business in the world and still lose money if you overpay on the way in. That gap between price and value is where real investing happens. Let us get into it. Our first company is a chip maker sitting right at the center of the AI hardware revolution. It competes directly for the hundreds of billions of dollars that cloud giants are pouring into next-generation computing infrastructure. Revenue has grown roughly 22% per year for the last decade, and its data center segment alone is projected to grow around 60% annually as AI demand accelerates globally. That company is AMD, Advanced Micro Devices. AMD dropped over 17% after its latest earnings, not because the business collapsed, but because Wall Street had priced in perfection and the guidance was not quite perfect enough. This is what happens when a stock runs over 100% in under a year. One small cloud on the horizon, and investors panic. Free cash flow came in at $5.5 billion last year. Profit margins have climbed from 8.5% a decade ago to over 10% today. Revenue growth has been almost entirely organic. No big acquisitions inflating the numbers. Those are genuine strengths worth respecting. But AMD has 2 serious problems. Returns on invested capital sit at only 2 to 3%. Weak for a company of this size. And shares outstanding have grown by 33%, meaning your ownership shrank quietly while you waited. Think of it like a pizza. You own 1 slice out of 10%. The company secretly cuts it into 13 slices. Suddenly, you own less of the same pie without doing anything wrong. That is dilution, and it is one of the most underappreciated risks in investing. Analysts project strong growth ahead, but projections are not guarantees. Remember Tesla. Nobody imagined it losing market share just a few years ago. Today, the story has completely flipped. AMD needs a lower price and a real margin of safety before it becomes a buy. Our second company just got crushed after earnings, down 20%. And the internet has declared it a dying business. But here is what every serious investor learns eventually. When the crowd turns this ugly on a company, that is exactly when you lean in and do the math carefully. Because fear creates opportunity. That company is PayPal. PayPal generated over $5.5 billion in free cash flow last year. Here's the part that should make you stop and think. That is actually more than it produced back in 2021. The same year the stock was trading at $310 per share. Today it sits around $40. Revenue has grown roughly 30% since the stock peaked. The cash this business generates has improved, while the price fell nearly 87% from its highs. PayPal still owns Venmo, one of the most trusted peer-to-peer payment apps in America. It is buying back roughly 20% of its own shares, the complete opposite of AMD's dilution problem. A clear signal that management believes the stock is cheap. Returns on capital are strong. New leadership just stepped in to sharpen execution. Analysts see earnings growing from around $5.95 per share this year to over $9 by 2027, with steady revenue growth in the 6 to 7% range. For a stock at single-digit free cash flow multiples, that is genuinely hard to walk away from. Drop a comment right now. Do you think PayPal is a value trap or a real opportunity? We read every single one. Our third stock just fell nearly 40% from its highs after news broke of a massive proposed acquisition. That company is Netflix. The concern is a potential $82.7 billion deal for Warner Brothers Discovery assets. Significant debt and real execution risk. But Netflix's core business never stopped delivering. The company generated $9 billion in free cash flow last year, more than double what it produced 5 years ago. Operating margins are climbing past 31%. Revenue is projected to grow 13% in 2026. Analysts see earnings growing from roughly $33 per share this year to over $53 by 2027. Netflix is the first streaming app most people open when they want to watch something. Not because they have to, but because they want to. That kind of loyalty is a deep competitive moat. The question for us is not whether Netflix is a great business. It clearly is. The question is whether patience gives you a meaningfully better entry point than today. We are watching closely and waiting. Share this video with someone who needs this analysis before February ends. It takes 2 seconds, and it helps Market Authority keep producing content like this every week. Now our fourth stock is one of the most interesting situations in the entire market right now. A business the market has written off for a reason the numbers simply do not support. That company is Adobe. Down over 40% from its all-time high of $699, the market fears that generative AI will make Adobe's creative software irrelevant. But look at what the numbers have actually been doing. Adobe's free cash flow has grown every single year. 6.8 billion, 7.4, 6.9, 7.99, and nearly $10 billion most recently. That is not a business being destroyed by competition. That is a business getting stronger. Free cash flow is actually higher than net income, which tells you this cash is clean and real. At around $257 per share, Adobe trades at just 11 times free cash flow. The company is buying back shares aggressively. Returns on capital are improving every year. Analysts project 9 to 10% revenue growth annually for the next several years. If AI truly destroys Adobe, avoid it. But if the fear is overdone, and the cash flow trend suggests it is, the valuation gap here is genuinely compelling. Stock number 5 will generate the most debate in the comments, because this business is extraordinary in almost every way. The technology is real, the growth is real, the moat is real. But there is one number that changes everything. That company is Palantir. Its software helps governments and corporations extract actionable intelligence from massive, chaotic data sets in ways no other platform can replicate. It is critical infrastructure for defense and intelligence agencies, now expanding powerfully into the commercial enterprise market through its AI platform. Revenue grew 70% in Q4 alone. Management guides for 61% growth in 2026. Gross margins are 81%. No debt, more cash than it owes. Free cash flow jumped from a 5-year average of $730 million to $1.8 billion last year. By every operational measure, this is a special business. The problem is the price. Palantir carries a market cap of around $344 billion, while generating about $1.1 billion in net income, over 300 times earnings. Shares outstanding have grown 31% as well. Even with optimistic analyst projections plugged in, the math of earning a strong return from today's entry price is extremely difficult. Investors buying today could still be disappointed for years because so much future growth is already priced in. We deeply respect the business. We cannot justify the price. We are staying on the sideline. Our sixth and final company is so embedded in daily life, it almost feels like a public utility. That company is Google, more precisely Alphabet, up roughly 67% over the past year, but recently giving back 6 to 7%, as investors worry about two things. First, Alphabet is spending enormous sums on AI infrastructure, widening the gap between net income and free cash flow. Second, regulatory pressure globally creates uncertainty around Google's search dominance and advertising pricing power. These concerns are real, but here is the business reality. Alphabet generated $73.5 billion in free cash flow last year. Profit margins expanded from 25% a decade ago to 32% last year. Proof the company keeps getting more efficient at scale. Google Cloud is becoming a powerful second engine. Analysts expect earnings per share to grow from $11.27 today to roughly $17.75 over the next few years, about 15% annually, while revenue expands 11 to 13% per year. At 30 times earnings and 57 times free cash flow, it is not cheap. But for a business with this durability and cash generation, patient long-term investors are likely to be rewarded. So here is the full picture. PayPal and Adobe are our two strongest opportunities right now. Businesses where market fear has pushed prices meaningfully below what the underlying cash generation justifies. Both generate serious, growing free cash flow. Both are buying back shares. Both offer real margin of safety for patient investors. Google belongs on your watch list. A world-class compounder that gets more interesting every time Wall Street overreacts short-term. AMD needs a lower price and cleaner capital allocation before earning a buy. Netflix needs more compression before new money is safe. And Palantir is a business we admire and a stock we will not touch at this valuation. The mindset that separates wealth builders from story chasers is simple. You do not make money by finding the most exciting narrative. You make money by finding situations where the price the market offers is significantly below what the business is genuinely worth, and then having the patience to wait for that gap to close. Buying great businesses at fair prices, holding through the noise, and letting compounding work over years. That is the engine of real lasting wealth. If this breakdown gave you clarity on any of these stocks, hit the like button and subscribe to Market Authority. We are here every week doing this work so you do not have to guess. And as always, everything in this video is for educational purposes only. This is not financial advice. Not now, not ever. Every investor's situation is different. Your risk tolerance, timeline, and goals are uniquely yours. Do your own research and speak with a qualified financial professional before making any investment decisions. At Market Authority, our job is to help you think better, not to think for you. We will see you in the next one.